Hello and welcome. My name is Simon French and I'm the Chief Economist at Panmure Gordon. Today we're just going to reflect on the US Federal Reserve's June meeting and what that means regarding the rest of 2019 and monetary policy, inflation, and what the major takeaways were. So the first thing to say is actually the dot plot of FOMC members' expectations for interest rates in the US was unchanged in terms of the median view on where interest rates will be. The dots themselves moved around quite a lot, but the median position was for rates to remain unadjusted. However, there were seven rate setters, or seven members of the FOMC, who actually saw two interest rate cuts this year. And that in itself was enough for equity markets to rally off the back of it, anticipating that the Federal Reserve will indeed start to cut interest rates for the first time since the financial crisis and start to introduce looser monetary policy into the US economy. So look, one of the uncertainties going into the meetings in July, September, December, the meetings where the Federal Reserve may cut interest rates, is whether they will be doing it against the dual mandate of of inflation and maximum employment, or whether some of the political pressure that has come to bear from the White House is influencing decision making. So let's take the first part of the mandate. In terms of employment, well, the US unemployment rate at about 3.6% is at a near 40-year low. It hasn't yet bottomed out. And typically, the Fed starts to cut, according to our analysis, about 8 months after the US unemployment rate has started to tick up. That hasn't yet happened, so this would be, if we start to see a cut in 2019, an early cut, perhaps a precautionary cut from the Federal Reserve, but there's no compelling case coming out of the labour market suggesting that a weakening in that labour market is a justification for a rate decrease. Now, the second part of the mandate is on US inflation, which has undershot the 2% target for some time, certainly on the core measure. And with it having undershot quite materially in the first half of 2019, there is more of a case for Federal Reserve members who are concerned about impacts of sustained low inflation of the type that we've seen over the last 2 decades in Japan, and we're increasingly seeing in the Eurozone, of wanting to cut interest rates to try and get ahead of that, stimulate some inflation into the US economy, and of course, avert some of the problems that come with structural deflation setting in. And the final part, of course, of their calculation has to be the political decision-making of the White House. And clearly, the growth slowdown recently has been largely attributable to a very mercantilist view on trade. And whether tariffs are ramped up from here on China, US-China tariffs, or whether they are dialed back, will be a key determinant of the rate path and whether we get a rate cut at all, and if we do, multiple rate cuts going into the year. Our own view is that the Federal Reserve currently are looking to buy a bit of time, looking for some clarity on the White House, particularly on trade tariffs and also the emerging situation regarding oil prices with the tensions between the US and Iran. So I think it's too early to go with where the bond market is pricing multiple rate cuts. I still think the economic case struggles to justify that, and the calculation for investors must be looking at the White House rather than the Federal Reserve for the next clue.